Want to master the art of investing? Well, you've come to the right place. You see, investing isn't just about throwing money into the stock market and hoping for the best. No, it's much more than that. It's about understanding the market, making informed decisions, and having the patience and resilience to weather the inevitable ups and downs. In the next quarter of an hour, we're going to delve into the world of investing as seen through the eyes of Robert Kiyosaki, renowned author of Rich Dad, Poor Dad. We'll explore his 6 simple rules for investing, rules that have guided him and countless others to financial success. But first, let's talk about Robert Kiyosaki. He's not just an investor but a businessman, an educator, and a motivational speaker. Born into a middle-class family, Kiyosaki rose to prominence with his unique perspective on wealth and investing. He believes that financial education, a long-term vision, control of finances, learning from history, protection from loss, and giving back are the 6 pillars of successful investing. Why are these rules so important? Well, they provide a solid foundation for anyone looking to navigate the often tumultuous seas of investing. They're not just about making money, but about developing a mindset, a way of thinking that can help you not just in investing but in life. Investing is an art. And like any art, it requires practice, patience, and a deep understanding of its principles. Kiyosaki's rules provide a roadmap, guiding us through the complex landscape of investments, helping us understand where to go, what to do, and how to make the most of our financial resources. So are you ready to dive into the world of investing with Robert Kiyosaki's 6 simple rules? Because we're about to embark on an exciting journey. One that could change the way you think about money and investing forever. So buckle up because the world of investing is waiting for you. The first rule is all about financial education. Now, what exactly does that mean? Well, think of it this way. Would you play a game without knowing the rules? Probably not. Yet many people venture into investing without a clear understanding of financial terms, markets, and trends. It's like stepping onto a football field without knowing what a touchdown is. You're bound to fumble. Financial education is about more than just understanding the difference between a stock and a bond. It's about understanding the economic factors that affect their value. It's about recognizing market trends and knowing when to buy, hold, or sell. It's about comprehending the interplay between inflation, interest rates, and investment returns. Robert Kiyosaki emphasizes this rule because he knows that an investor who understands these concepts is an investor who is better equipped to make informed decisions. He often refers to this as financial intelligence, and it's a game changer. It's the difference between investing based on hearsay and investing based on a deep understanding of financial realities. But why is this rule so important? Well, consider this. Do you want to rely solely on a financial advisor's advice, or do you want to understand the advice you're given and make your own informed decisions? The answer seems pretty clear, right? Financial education gives you the power to take control of your own financial future. It allows you to navigate the financial landscape with confidence and make decisions that align with your financial goals. It helps you recognize opportunities and avoid pitfalls. But here's the thing. Financial education isn't something you acquire overnight. It's a lifelong journey. The financial world is ever-changing, and staying informed requires continuous learning, but the effort is undoubtedly worth it. So, how do you start this journey? You read, you listen, you ask questions. There are countless resources available, from books to podcasts to online courses. Start where you feel comfortable and keep pushing your boundaries. Remember, knowledge is power. The more you know about finances, the better decisions you can make. Kiyosaki's second rule is to have a long-term vision. Now, what does that mean? Essentially, it's about seeing the bigger picture. It's about understanding that investing isn't a sprint, it's a marathon. Think about it this way. When you're on a long journey, do you stop and turn back every time you hit a small bump in the road? Of course not. You know your destination, and you understand that the road to get there might not always be smooth. Investing is no different. The market will fluctuate, there will be ups and there will be downs. But if you've done your homework, if you've made thoughtful, educated decisions, then you should feel confident in your journey. Why does Kiyosaki emphasize this rule? Because he understands that panic and fear can be an investor's worst enemies. He knows that the people who succeed are the ones who stay the course, who don't get rattled every time the market takes a little dip. These are the people who keep their eyes on the prize, who never lose sight of their long-term vision. Kiyosaki isn't saying that you should ignore market trends or dismiss new information. What he's saying is that you should make your investment decisions based on solid research and thoughtful consideration, not on knee-jerk reactions or fear of short-term losses. And here's the thing. When you have a long-term vision, you're not just investing in a company or a commodity, you're investing in a future. You're investing in the world you want to see. And that's a powerful thing. So remember, investing isn't about making a quick buck. It's about making a lasting impact. It's about building a future for yourself and for the world. And to do that, you need to have a long-term vision. You need to be able to see beyond the immediate ups and downs of the market. You need to be able to see the bigger picture. So, always keep your eyes on the prize and don't get distracted by short-term noise. Because in the end, it's the long-term vision that matters. It's the long-term vision that will lead you to success. Rule number 3 is all about control. In the grand game of wealth, control is the name of the game. It's not just about how much you earn, but how well you manage what you have. Robert Kiyosaki, the master of investing, emphasizes this rule because he understands one fundamental truth. The key to financial freedom lies in the control of personal finances. Let's break it down, shall we? First, understanding cash flow. It's a simple concept, yet often overlooked. Cash flow is the movement of money in and out of your wallet. It's the income you earn, the expenses you incur, and the investments you make. To control your cash flow, you need to know where your money is coming from and where it is going. Be aware of your income sources and keep track of your expenses. This will allow you to make informed decisions about your money and guide it towards your financial goals. Next, minimizing liabilities. Liabilities in simple terms are what you owe. They can be loans, credit card debts, mortgages, or any other financial obligations. Controlling your finances means minimizing these liabilities. The less you owe, the more you own. So, strive to pay off your debts as soon as possible. It might be tempting to splurge on luxuries, but remember, every dollar spent on liabilities is a dollar taken away from your assets. Speaking of assets, let's talk about maximizing them. Assets are what you own: properties, stocks, businesses, or any investments that generate income. The more assets you have, the more income you generate. So focus on accumulating assets. Invest wisely, diversify your portfolio, and let your money work for you. Remember, the goal is not to work for money, but to have money work for you. Controlling your finances is not an easy task. It requires discipline, planning, and a clear understanding of financial concepts. But once you master it, you will be on your way to financial freedom. Remember, control your money or it will control you. Kiyosaki's fourth rule is to learn from history. A simple statement, yet profound in its implications. History, as they say, tends to repeat itself, and this is especially true in the world of investing. Past market trends and economic cycles can provide invaluable insights into how the future might unfold. Let's consider the stock market, a beast that thrives on cycles. It has its periods of euphoria, often followed by times of despair. If we look back at the dot-com bubble of the late 90s, investors were euphoric about the potential of the internet, driving tech stock prices to stratospheric levels. But when the bubble burst, many were left with significant losses. Fast forward to the housing crash in 2008, another bubble burst, again leaving many in financial ruin. These historical events are not mere anecdotes but powerful lessons. They teach us about the dangers of speculation, the importance of understanding what you're investing in, and the perils of following the herd blindly. Robert Kiyosaki emphasizes this rule because he believes that by studying history, we can better predict and prepare for the future. It helps us understand that markets move in cycles, that what goes up must come down, and vice versa. It teaches us to be patient, to wait for the right opportunity, and not to be swayed by the emotions of fear and greed. But it's not just about learning from the mistakes of the past, it's also about drawing inspiration from success stories. Consider the investors who saw potential in companies like Amazon and Google in their early days despite the skeptics. They studied the market, understood the potential, and their foresight paid off handsomely. In essence, history serves as a guide, a tool that can help us navigate the often turbulent waters of investing. It's about learning to recognize patterns, understanding the underlying forces that drive market trends, and making informed decisions based on that knowledge. So as we move forward on our investment journey, let's keep this rule in mind. Let's learn from history, not just to avoid repeating the mistakes of the past, but to replicate and build upon the successes. Remember, those who do not learn history are doomed to repeat it. Rule number 5 is about protection. It emphasizes the importance of safeguarding your investments from potential losses. Now you might be wondering, how does one protect their investments? Well, there are several strategies you can utilize to achieve this, and we'll be highlighting some of them. Firstly, we have diversification. This is a risk management strategy that mixes a wide variety of investments within a portfolio. The rationale behind this technique contends that a portfolio constructed of different kinds of investments will, on average, yield higher returns and pose a lower risk than any individual investment found within the portfolio. Diversification strives to smooth out unsystematic risk events in a portfolio, so the positive performance of some investments neutralizes the negative performance of others. Secondly, there's risk management. It's about identifying, assessing, and understanding the risks before making any investment decisions. By understanding the potential risks, you can make informed decisions that align with your investment goals and risk tolerance. Risk management also involves regularly reviewing your investment portfolio and making adjustments as needed to maintain the desired level of risk. Lastly, we have insurance. While not directly related to investment, insurance is a tool that can protect you from financial loss. For example, if you're investing in real estate, having property insurance can protect your investment from damage due to unforeseen events. Similarly, life insurance can provide financial security to your loved ones, ensuring that your investments are not liquidated prematurely due to unexpected life events. Robert Kiyosaki emphasizes this rule because he understands that the world of investing is not always smooth sailing. There are times when the market is volatile and investments can depreciate. By protecting your investments, you are not just preserving your capital, but also ensuring that you have the potential to bounce back and continue on your investment journey. So my dear friends, let's not forget rule number 5, protection from loss, because after all, remember, protection is better than cure. The final rule is all about giving back. In the realm of investing, this might seem like an odd rule to highlight. After all, isn't investing all about maximizing personal gain? Well, Robert Kiyosaki, the master of investing, begs to differ. Rule 6 is about acknowledging the role of our communities in our success and reciprocating their support. It's about understanding that our prosperity is not an island. It's deeply interconnected with the society we live in. Successful investors are often those who recognize this interdependence and actively contribute to their communities. These contributions can take many forms, from setting up educational scholarships, funding local businesses, supporting charity organizations, to initiating environmental projects. The point is not just to give back, but to invest back into the community that has facilitated our growth and success. But why is this so important? Why does Kiyosaki place such emphasis on this rule? Well, aside from the moral and ethical reasons, giving back has practical benefits too. It fosters goodwill and builds stronger relationships within the community. It helps create a more equitable society where opportunities are not just hoarded by a few, but shared among many. This, in turn, contributes to a more stable and prosperous economic environment, the very environment in which our investments thrive. Moreover, giving back is a way of expressing gratitude. It's about recognizing that our success is not solely the outcome of our individual efforts, but also the product of the opportunities and support we've received from others. In essence, giving back is not just a nice thing to do, it's a smart investment strategy. It's an acknowledgement that we are part of a larger ecosystem, and the health and prosperity of that ecosystem directly impacts our own success. So, as we strive to master the art of investing, let's not forget this pivotal rule. Let's not forget to give back, to invest in our communities, and to foster a culture of shared prosperity. Remember, the more you give, the more you receive. Let's review what we've learned today. We began with the first rule, the foundation of it all, financial education. Understanding money, how it works, and how it can work for you is crucial. Then we moved on to the second rule, long-term vision. It's not about quick gains, but about seeing the bigger picture and planning for the future. Next was control of finances. It's essential to know where your money is going and how it's being used. Following this, we delved into the fourth rule, learn from history. The past is a great teacher and can offer valuable insights for future decisions. We then discussed the fifth rule, protection from loss. It's not just about making money, but also about safeguarding what you have. Finally, we touched on the sixth rule, giving back. Investing isn't just a means to amass wealth, but also a way to contribute to society. Investing is not a gamble, it's a game of skill. And with these 6 rules, you're well on your way to becoming a master of the game. Good luck on your investing journey.